sesh on theme 1. This is for Edexcel. Let's start with the bread and butter topics. So the first question is why new business ideas come about. So that could be because of changes in technology, changes in what consumers want, or products and services. They just become obsolete, out of date. The next question, how new business ideas might come about. Well, a new business idea is going to be because of an original idea, or you've adapted an existing product, or adapted an existing service, or adapted an existing idea. Next question is, what is the impact of risk on a business? Well, the impacts are going to be business failure, financial loss, lack of security. What is the impact of reward on a business? Well, the rewards to a business would be business success, profit, and independence in the case of a sole trader. What's the purpose of a business? Well, it's to produce goods or services, to meet customer needs, and then to add value. Adding value, we're thinking it could be design, USPs, unique selling points, branding, quality. What's the role of an entrepreneur? Well, an entrepreneur, they look to organise resources, they've got to make business decisions, and of course they've got to take risks in order to get that reward, which could be business success, profit, or independence. What are customer needs? Well, customer needs, you're thinking price, you're thinking quality, you're thinking choice and convenience. Why are customer needs important? Well, if you meet your customer needs, you'll be able to generate more sales, increase your sales, and that should help with business survival. The next session is on market research. So market research, well, what's the point of market research? To identify gaps in the market, to reduce risk, and to inform business decisions. Next question, what is primary research? So primary research is the collection of original data and information for a specific purpose. The types of primary research, well, they would be survey, questionnaire, focus groups. Remember, focus groups are a qualitative form, and observation. What is secondary research? So basically, you've nicked it from somebody else. The types would be internet, market reports, or government reports. What is qualitative and what is quantitative data? Well, qualitative is non-numerical. You're looking for quality in your answer. It's collected through methods such as interviews, particularly focus groups, and observation. Meanwhile, quantitative data is data that is measured in numbers, and it's represented in numbers, and it's often collected through surveys. Remember to question the reliability of market research. So we're thinking, who did the market research? Are they experienced? Are they biased? These are the things you might want to question within a market research question. Next sesh, segmentation. What are the various segments the business may target? Well, that would be location, demographics, lifestyle, income, and age. And what tool do they use to find the gaps in the market? Of course, they use market mapping to find the gap in the market. Next sesh, competitive environment. Well, businesses will compete on price, quality, product range, where they are, so location, customer service, and if they are able to be better than their rivals at that, they will have a competitive advantage. Next sesh, aims and objectives. So financial aims and objectives, well, that would be survival, profit, grow sales, grow market share, give the owner financial security. Continuing, non-financial aims and objectives. Well, non-financial, not financial aims and objectives would be social objectives, personal satisfaction, challenge, independence, control. Moving on, profit, revenues, costs, concepts, big ones, formulas here to learn. Make sure you've got these locked down. Profit equals revenue minus total costs. It's always helpful when it's total costs because total costs, or TC, is total fixed costs. Those are the costs that do not change with output, TFC. And then you add that to total variable costs. They're the costs that do vary with output. So TC equals TFC plus TVC. TVC, total variable cost, well, that's variable cost per unit, per one thing, times by how many things you made. Break-even output. So break-even point in units, or BEP as I put there, that's total fixed costs divided by the price minus the variable cost per unit, per one thing. So that's the total fixed costs divided by the price minus the variable cost per one unit. Break-even point in pounds. Well, that's going to be the break-even point in terms of how many units times by the price. The margin of safety. Well, the margin of safety is the actual sales minus the budgeted sales. Break-even analysis. Remember with break-even analysis, if total fixed costs or fixed costs, well, if they go up, that means your break-even output goes up. It gets bigger, bad. If total fixed costs go down, for instance, your rent decreases for whatever reason, or your break-even output will be lower, good. Next thing to think about, break-even pros. Well, break-even is good because you can make production, you can make pricing decisions based on your break-even. But it's bad, or issues could be, because it's only an estimate and it assumes that sales equals output. And that's mistaken. You could have defects, you could have recalls, you could have economies of scale, which affects that too. So there's limitations with break-even analysis. Cash flow. Cash flow, well, why is it important? Well, it's important to pay your suppliers, pay your overheads, pay your employees, wages, to prevent business failure, so insolvency. And also you want to think about the fact that profit and cash flow are not the same thing. Cash flow formulas. So cash flow formulas, big one, net cash flow. That equals cash inflows minus cash outflows. Your opening balance is the closing balance of the previous period. So if it's the first of the month, then that must be, you're taking your closing balance from the previous month. That's the 30th or 31st. Or if it's a leap year, the 29th of February. Closing balance equals opening balance plus net cash flow. So your opening balance, what you start the month at the first of the month, take that, then add on how much you made in that month, being the difference between the cash inflows and cash outflows. And remember with this, if you see it in brackets, that means negative. Sources of finance. So sources of finance, you've got short-term sources of finance, Orange County, overdrafts, creditors. So short-term finance is overdraft and trade credit. Then long-term sources would be personal savings, venture capital. Remember, venture capital is a type of investment that is made in the early stage companies with high growth potential. Share capital, well, that's the total money you get if you're a company, raised by selling shares to investors, to shareholders. Loans, well, you get those from a bank, is a type of debt, and you obviously have to pay interest on that. Retained profits, well, that's your net profit, taking away all the dividends that have been paid out, and it's the ongoing historical total of this. And then crowdfunding, that's the practice of funding a project by raising small amounts of money from a large number of people, typically via the internet. Limited liability. Well, that limits the financial liability, the losses of a company's owners, to the amount of their investment. That's an advantage to a private limited company, an LTD. It's a disadvantage for sole traders and partnerships. Limited liability part 2. Well, when we're thinking about limited liability, we want to relate that to sole traders, to partnerships, and to private limited companies. I'll remind you, sole traders, limited liability, they don't get that. They have unlimited liability. Partnerships, unlimited liability. They don't have limited liability. Private limited companies, it's in the name, limited. Private limited companies, they will have limited liability. Now, if we're thinking about sole traders, well, an advantage would be full control of decisions, full control of profits. They keep them all because they're the one person that owns the business, and it's easy to set up. Disadvantage, unlimited liability. Partnerships, well, an advantage of that would be more finance from that additional partner or partners. They might have more expertise they can bring to the business. Fantastico. And then disadvantages, unlimited liability. Or you might get beef if you've got conflict between the partners. Private limited companies, the advantage, so access to share capital. You can sell shares. You can get money from shares. Share capital, equity finance is the other name for it. And of course you get limited liability. Disadvantages, where you give up ownership and perhaps decisions and perhaps even dividends. Divvies! Running a franchise operation. So the pros of running a franchise operation, so you buy into the franchise. Number 1, proven business model. Number 2, already has brand recognition. That's great for you. It grows awareness, easy to make sales. Number 3, support from the franchise or expertise they might have. That could benefit you. They could help you along the way to become the franchisee. Number 4, less risk versus going alone. If you're going to go alone as a small independent, well, maybe it's easier to just buy into a franchise. Disadvantages, high startup fees. You might have to pay a fee to buy into that franchise. McDonald's, I think, is $500,000. You might have to pay royalties, so a percentage, a cut of the profits. McDonald's, I think you have to pay 5% cut. And then there's the lack of flexibility if you set up as a franchise operation, because you've got to be consistent with the other franchisees and what the franchisor wants. Number 4, business location. Well, what matters in terms of business location? How close you are to the market. What do you do? Are you a manufacturer? It doesn't really matter if you're near the market then. Versus if you're a convenience shop, a retail shop, you'll want to be near footfall. But then again, do you sell online? Because if you sell in e-commerce, it might not make so much of a difference, so it matters perhaps less. Marketing mix. Price, what do you charge? Promotion, where, how do you promote? Product, what's unique about your product? Place, how does the customer purchase it? Also think about the impact of e-commerce, because e-commerce and the evolution of websites has impacted promotion. Digital marketing is huge now, and it's impacted place, because convenience now. You don't have to go to the shop, you go for the internet, it's delivered to your door. 16. Business plans. Why is the business plan important? Well, to explain the business idea, to show the aims and objectives and what the target market is. It might even help secure finance. For example, a loan from a bank will be more likely to get if you've got a business plan. Cash flow forecast. It shows how liquid the business is, how much cash they've got. Profit and loss. You'll probably want to chuck one of those in to estimate your likely profits. And then you might want to show how the marketing mix, the 4 Ps we just discussed, will be deployed. And if you do a business plan, it minimises risks, it reduces risk. Next one, stakeholders. Know your types of stakeholders. So your stakeholders are shareholders, not the same as stakeholders. Shareholders are owners, employees, they work for you. Owners, customers, managers, suppliers, local community, government and pressure groups. Couldn't fit it all in. And remember conflicts. So, for example, there's always conflicts between stakeholders. A shareholder might want more dividends, divvies, but that could be at the expense of employees getting pay rises or getting training courses. 18. Technology. Types of technology a business uses. Think about digital communication. That's just how you communicate digitally, like text, emails, Teams. Social media. E-commerce, payment systems, all types of technology a business uses. 19. Legislation, laws. What's the point of consumer law? Well, ensure quality is there and consumer rights are upheld. What's the point of employment law? Ensure employees are protected in terms of pay, like minimum wage or national minimum living wage if you're older than 25, I think. Recruitment, no discrimination, of course. And workplace is safe. And the Health and Safety Act 1974. Laws, legislation, well, they usually mean more costs for the business. And if they do not meet the laws or legislation, they might get fined. Economy, number 1. What's the impact of unemployment? It means a wider pool of available workers, as they are unemployed, but suggests people have lower incomes, less spending on businesses. Economy, number 2. Impact of increased consumer income, more spending on luxury goods. They should increase stock levels, staff levels accordingly. Economy, number 3. What's the impact of increased interest rates? Remember this happening in the economy right now. Interest rates are going up, 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 up. If businesses have debts like overdrafts, like loans, if there's higher interest rates, that means higher interest repayments, means higher costs, means lower profits, means the business might invest less. If consumer has debts, well, increased interest rates will mean that they might have to pay more on those debts, which means they have less disposable income, which means less spending on luxury goods in particular. Number 4, economy. Impact of increased taxes. Remember, there's different types of taxes. There's income taxes, corporation taxes, and VAT. So talking about income taxes, well, if income taxes go up, that means less disposable income, which means it impacts luxury goods first. Corporation taxes, that's taxes on companies' profits. Well, if it goes up, it means less profits. Less profits might mean less investment from the business. VAT will mean higher prices. Higher prices means law of demand, less demand. Next one, economy 5. What's the impact of increased exchange rates? Well, just think spiced. Strong pound, imports cheap, exports dear. It's good for those businesses that import, because that's the imports cheap bit. And then it's bad for those businesses that export, because it seems dearer. Remember, strong pound is spiced, if it's weak pound, it's whipperdeck. External influences. What else impacts a business but they cannot control? Well, new laws, new legislation. Think about if you had a plastic straw company. Problems now. Changes in technology. Things go out of date. Blockbusters is where I used to watch my movies. Now, boom, boom, Netflix. Economic climate changes. So recessions happens, booms happens. Hope that helps. See you at the next sesh.